Yeah, greetings everyone. I'm so excited on this one because I think the last two we were at midnight or 10 o'clock, something like that. It probably felt like. So I think I got the better end of that job of being able to do this at lunchtime instead of at 7 o'clock. So I'm not sure who I paid off to get that done, but I'm excited about it. So yeah, we'll give everybody a few more minutes as we get launched. We'll leave it on this super cool people driving motorcycles down the street here. And while we're waiting, I'll go ahead and put up the ever so lovely compliance page that we make sure that nobody goes to jail. And the running joke is, we don't know anything. Anything we do know is purely by accident. And this isn't actual advice. These are just some concepts and some hypotheticals for information purposes. But we're sure glad everybody's here. And then Carrie, just let me know when you're ready, and we can let everybody have a minute or two.
I think we are ready to roll when you are.
All right. Well, the goal of today is to really walk through sort of the investment side of what we do. The past two webinars that we've done, the first one was really about how do we generate income? How do we maximize income for retirement? And how do we position assets so that we're doing that? The second webinar was really about the private reserve system, the idea of how do we use our money more efficiently? How do we flow it through our system in a much more efficient way? And today is really all about sort of this idea of diversification, and this idea of how do we make not only good investment choices, but investment choices that we can actually sustain for the long run. And so one of the things I wanted to kind of walk through is sort of a little bit of a history lesson and sort of where diversity is coming from and why it's so important. So if you think way back in the dark ages of the late 70s, early 80s, so 50 years ago, the world of retirement planning looked very different than it does today. So in those days, many families had their retirement plan really based on what we would call the three-legged stool. And the stool was made up of Social Security. You had a pension from a company that you worked for, and you had an investment bucket. And when it came time to retire, and your thoughts of building this magical net worth slowly shifted from net worth to how do we maximize income, the great thing about that system is that Social Security and pensions actually made up 70 to 80% of your income. And that meant that the investment leg of the stool, its job was important. It had a role, but it may have only been responsible for about 20 to 30% of your income. And when you think about sort of the very often quoted advice that you really only need 80 to 90% of your income during retirement to replace your lifestyle, then that meant that the investment portion of your stool, the investment leg of your plan, was kind of icing on the cake. If you had it, if it was really great, if you made a bunch of good choices, good for you. If you made a bunch of bad choices and the market went the other way on you, then wasn't ideal, but it wasn't going to be detrimental hugely for the future. So if we fast forward 40, 50 years ago to today, pensions are largely a thing of the past. And more of the families that we work with are starting to become very nervous about the likelihood they're actually going to get Social Security. And so what that means is more and more of the pressure of retirement, of planning for retirement, is falling to that investment leg. And even if clients don't say it out loud, they don't say the quiet parts out loud, you can tell that they're feeling that pressure. And the way you tell it is usually the telltale question I get in meetings is, hey, we really need this money to grow. We don't have a lot of years left. We need this account to really drive this baby on home. And the usual follow-up question is, hey, I get it, but how do you feel about risk? So when you're swinging for the fences, you're swinging for more risk. And there's usually this kind of weird, uncomfortable pause, and they go, yeah, I understand, but hey, no pain, no gain, no risk, no reward. Let's go. Let's make this thing happen, right? And so the problem is that most everyone I've met is return tolerant. We'll take the big years, but not everyone I meet is actually risk tolerant. And so at least feeling some of this pressure on this account and the pressure for the investment leg to do more, it usually begs that next question is, why aren't we actually better at investing? because investing is just a bunch of numbers, right? You put X into the market, it produces Y, and we all retire rich and famous. So it's just math, right? So let's start out with a couple of quizzes. We're going to go through about 3 or 4 quizzes here just to kind of give you some context with what's actually going on in the market and how it actually affects you and how that actually affects kind of your day-to-day. So let's see how we do on some of these questions. So first question, if you invested $10,000 in the S&P 500, December 31st, 1979, and you left it alone, you didn't touch it for 40 years, and you took all your money out December 31st, 2019, how much would you have in your account? Is it A, 1.1 million? Is it B, 867,000? C, 643,000? Or D, 418,000? So if you'll click on your investment buckets there, I may actually throw in one as well. I'll submit my own. I can do that. So, Kara, what's the going number?
We're still waiting for results.
Oh, okay.
Let's let everybody vote.
Sure. And so the idea is, what would 10,000 grow to over a 40-year period? Ah.
Everybody can see this, right?
Yeah, I can see that. Yeah, that's awesome. Yeah, so it looks like everybody picked 1.1, or the vast majority, between 1.1 and 867. So the number is actually 867,000. So the next question is, if you completely invested that $10,000, you never got out, invested it the whole way through 40 years in a row, you would have $867,000 in that account in 40 years. Now, the next question, what would your account look like if you missed just the best 10 days out of that 40-year time frame? So you missed 10 days out of 40 years. So would your account drop to 693? Would your account drop from 867 to 578? Would it drop to 418? Or would it drop all the way to 108? So give everybody just a second to enter in their choices, see what you got. Ah, you guys are super smart. Man, everybody's getting it right. Like there's no spoilers here. Yeah, so if I don't know if you can see the results on that, but if you had missed 10 days out of 40 years, your account would have gone from 867,000 to 418,000. So here's the full data. So in a 40-year span, if you miss 10 days out of 40, your account drops by over 51%. It's a huge impact. But if you go to the right side of that picture, one of the things I find tremendously fascinating is if you miss the best 50 days in the market, so the 50 days out of 14,600 days, so 0.3% of the days, you gave up over 90% of your potential, which is huge. So by that rationale from the data set, you can reasonably determine that being in the market, not getting out, and making sure that the ins and outs in the market actually matter. So in fact, there was a study produced by a group called the Dalbar Group, and they looked at a 20-year period from 1999 up to 2019. And what they found is that if you look at the average investor, so me, you, the average family down the street, and when you look at the raw performance in the market versus what the normal investor experiences, we're not keeping up. So if you look at the market from that 20-year period, the average investor in an all equity market underperformed the market by about 30%. If you look at the average investor in an all bond or all fixed income side of the portfolio, they underperform by roughly 90%. So what that means is if you're in a classic portfolio, classic design, which would be sort of roughly 60% equity, 40% bonds, that means that you underperform the market by about 15%, about 50%, or you could underperform about 50%. So the real question that comes back to, and the one real question that I kind of think through this is, why do we underperform? If we know that we're supposed to staying in makes sense, why do we underperform? And remember the weight that the investment leg is carrying at this point. And whether we know it consciously or not, we all feel that pressure, and that pressure is creating 2 fears. the fear of missing out. Oh my gosh, the market is raging. We've got to get in. All my buddies are buying Bitcoin and GameStop. Where do I park my money? Where do I go make that trade, right? Or the fear of losing out. Oh my gosh, we're at the top of the market. Inflation, taxes, yada, yada, yada. Insert your own favorite fear here. And we kind of hit that point where we're like, we're out. We pulled the ripcord, we pulled the parachute, we're out. So it's that fear of missing out and fear of losing out that's causing us to underperform. So by that rationale, the right answer would be to stay in, to never get out, right? And so the whipping that usually comes on the other end is you need to be a better investor. You need to be the steely spined, hard nosed, ice in your veins investor and never get out. But that may not be the actual right answer. So next quiz. This will be the second to the last. So from October of 2007 all the way through May of 2009, about 500 days, how much did the S&P 500 lose in value? Was it A, 23.8%? Was it B, 32%? C, 43.9%, almost 44%? Or D, 56.8%, almost 57%? So give everybody a second to answer those questions as well. So this is basically that big market correction in 08, but from the top of the market in 07 to the bottom in 09, how much did the S&P 500 lose in value? And this is one that I'm particularly interested to see what the answers are. It's fairly evenly split. So the actual answer is 56.8%. So from the top of the market in 07 to the bottom of the market in May of 09, the S&P 500 lost almost 57%. So let's walk through what that means and what that does. What that means is that on a $500,000 account in the span of 517 days, so less than 2 years, you would have lost almost $284,000 in your portfolio during that period. So last quiz of the day, and we'll quit peppering you with silly questions. So if you lost 56.8% of your portfolio, how much would you need to make? How much would you need to earn in the market the next year? Not to get you back to some fanciful number, but just to get back to where you started, to get you back to even. Would you have to make 161%, almost 162? Would you need 131% rate of return? Would you need 92% rate of return? Or do you need just 60% rate of return? So I have an answer on my own on that as well. So you lost 56, almost 57. How much do you need the next year to break even? Give everybody a couple seconds. Nice. Close. All right, for all of you guys, I don't know where I just got transplanted from. For all of you that thought it was 161, you were close, not quite. So you need 131.4% rate of return to get back up to even, to where your 500K becomes 500K again. And so the question that usually remains on the other end, and I think the clash summed it up best, should I stay or should I go? Is the answer to all problems get in and never get out? Or is the answer time the market on what you need to go do? Well, the answer is maybe a little bit of both. And the problem is not the market. The market is not the problem when you look at underperforming. I hate to break it to you, but the problem is you. Their problem is that there are two people vying for control over your brain at any given moment. There's what we call the elephant and what we call the rider. So I'm going to walk through those two pieces. So the elephant, the lovely, powerful elephant. The elephant is part of what we would call the reptilian brain. It's sort of the middle brain, and it's the oldest part of your brain. And it carries with it a couple of different sort of features, if you will. It's always scared. It's there to keep you alive. It can only see what's in front of it. It has no ability to sort of peer out into the future. That's a different part of your brain. It has no capacity for words or rationale or math. So when you get a gut feeling, when you get I'm not sure what's going on, but this doesn't feel right, or this feels good, it's not coming from the new part of your brain, the neocortex. It's coming from your elephant. The other problem with the elephant is it remembers everything. It remembers loss particularly, but it remembers everything that's going on. And the elephant is incredibly strong. This is the oldest part of your brain. The new part of your brain, the tinier part of your brain, is what we would call the neocortex, or what we call the writer. And the writer has a couple of cool features. The writer is incredibly bright. It can form words, it can do math, it can learn new things, it can analyze information, but has a couple of Achilles heels. One, it's incredibly weak. The neocortex part of your brain uses up a tremendous amount of energy. It gets fatigued very, very, very quickly. The other part is the writer is incredibly arrogant. If you ever want to know which part of your brain is the writer and which part of your brain is the elephant, if you've ever watched a moron dude driving down the road with a mattress on the top of his car and he's got his hand on the top going, I got this, that is his writer in control because he thinks he's got it, right? That's the part that's going on in your brain. And the problem is that the elephant is always awake. The elephant is awake 100% of the time. It's the elephant that picks up the phone, wondering why we aren't earning more money in the market. It's the elephant that storms into the office, ranting about why we're losing money. And it's the elephant that wakes the writer up in the middle of the night going, we're going to die. We're going to live under a bridge, surrounded by a bunch of cats, trying to figure out how we can get cardboard to sleep, right? It's the elephant that's doing all that. And which brings us to what I would call the investment paradox. While you can't let the elephant run the show, it's bad at making decisions and has no capacity for words or thought, you must never forget that the elephant is active in every single conversation about money all the time. And so what do? How do we solve this problem? So the answer to this is when the world is complex, and it is, and the writer is weak, and you are, the answer is to build a system, to build systems that allow you to take advantage of the market and to keep your elephant at bay. So let's walk through what that looks like. So the key to solving the problem is not diversification of assets. It's not just diversification of assets, although that's important. The real key to solving the problem to investing and long-term investing is a diversification of approach. And it's building an integrated system where all the parts are working together and doing their own job. So on the left side, we have strategic. This is what most people think of when they think about investing. It's the traditional approach. If you have a 401k, you most likely have a strategically managed portfolio. The next part is to start to add in some rules-based or a tactical approach to managing the responses to swings in the market. When the market goes up big, how do we respond to it? When the market's crashing, how do we respond to it? And the tactical does a great job in that place. The third piece is adding in a contractual element. And the contractual element is there to solve specific problems. And it's there to add bumpers to both risk and return. And the final part, and the part that I think I kind of love the most, is sort of the day trading element, right? If you think you're going to find the next Ethereum or the next GameStop or the next, I don't know, BlackBerry, whoever was racing up to the top of the market a couple of weeks ago, you know the day trading and the allure of being a day trader and what that brings to you. So the key is to add that component in and to keep the rider and the elephant engaged in that part without it being destructive. So let's walk through really quickly what strategic looks like. So if you've ever seen a pie chart, if you've ever played Trivia Pursuit, if you've ever used a pie chart as an explanation of how you're managing your money, you've seen strategic investing. And the way it works is depending on your risk tolerance, you have more red pie pieces than blue or more pink than yellow, right? You're building in a model of asset diversification. And the writer loves strategic investing. It's pretty pictures, there's little orange and blue pie pieces. We're very excited about how we're doing it. The elephant absolutely hates strategic investing, and here's why. When you have a diversified portfolio, you are by definition muting both the wins and the losses. That's its job, right? And when the market is up big, the bonds that are part of that market, that are part of your portfolio, are creating drag. It's slowing down the return. When the market is crashing, when we're in an 08 environment, an 01 environment, it's the equity side that's leading that race to the bottom, right? And here's how these meetings typically go. Meeting one, hey, Eric, I'm a little upset. Why are you upset, Steve? Well, I talked to my buddy down the street. You know Dave. Yeah, I know Dave. He said, and we looked on the internet the other day, because if it's on the internet, it must be true, that the market was up 30%, and I looked at my portfolio, and I'm only up 20. What the heck? What do I pay you for? Well, Steve, if you remember, whenever we set this up, we had this little pretty pie chart. We added in some bonds to help you sort of mitigate risk and return in your portfolio. Steve goes, oh, fine. The rational part, the writer understood that explanation. The elephant is pissed. The elephant's maybe not pissed. He's annoyed. Situation 2. Hey, Eric, I'm really upset. I just lost 20% of my portfolio. What the heck? And I go, Steve, we're so excited that you lost 20% this year. He's like, why? He says, well, everybody else lost 30. You're only down 20. We're really great. Remember those bonds we added those to the portfolio that you were sort of upset about the other day? They saved your bacon this week. They saved your bacon this year. They helped you prevent a bunch of losses in the market. Seems like, fine, I get it. And the elephant is still at the kiddie table, sort of annoyed by what's going on, because the elephant wants all the ups and none of the downs, right? So the problem with strategic investing, and the key message with all strategic investing, is don't touch it. It's like your mask. Don't touch your face. We all saw how that worked out, right? And the problem is that the rider is constantly fighting the elephant and getting tired, because the elephant is bigger and stronger, right? The fear of missing out, more red pie pieces. We got to go big, right? Fear of losing out, no more red pie pieces. Go back to safety, right? So the way we solve some of this problem is by adding in some other components, a different approach. And one of them is a tactical approach, right? The key on this one is we need pie charts. But the problem is we need to be able to adjust to what's going on in the market real time, when the market is raging up and when the market is crashing down. The key is to use rule-based algorithms, not Bob and the machine. It's a rule-based, not some human in the mix. And the reason we do that is because A, 57% drops in your portfolio are bad for your future. Anyone that tells you otherwise, they need to come see this presentation. Right. The other reason why we use computers is because computers don't own elephants, right? It's making a decision based on a rule set, not based on Bob and what he had for dinner last night and what he kind of felt about the market. So I'm going to walk you through what a tactical situation looks like and how it actually fits in a broader situation, a broader system. So when we look at adding in a tactical or an active approach to a client system, we're not looking to predict the future. That's a very different service than what we provide here. There's a lady down the street with a little globe and creepy music in the background. She'll help you with that part of it. That's not our job, right? In a tactical approach, we're typically replacing the idea of separate diversified mutual funds or positions with this idea that we want separate rule sets and algorithms. So there's hundreds of algorithms to choose from, and it's just like a diversified portfolio. There's no one magic algorithm. We're trying to build them into a system so that we manage risk and return and growth, right? So this slide here is meant to explain one algorithm, not all of them. We don't have that much time today, but I want to give you a sense of how this works. So this is what I would call a trend following algorithm. And it's meant to respond when the market's up. It's meant to respond when the market's down and when the market's sideways. And this one in particular follows the NASDAQ 100. And it's looking at long-term trends, 200-day trends versus a 20-day moving average in the market. And the key is the simplicity in that it can only be in one of 4 positions. So let's walk through what this looks like. So this is my super technical, super accurate, super scalable version of what I think the NASDAQ might look like in the future, and the long-term trend of what's going on. And I'm going to walk you through how this might look. So there are times when the market, the NASDAQ, is up. It's not up a lot, but it's growing. And so we want to take advantage of that. So in this algorithm, in this rule set, what it's going to do is move into what I would call a 1x position, which means everything the NASDAQ 100 gets, you're going to get that same thing. But there are times when the market is not just up, it's up big. So if you ever thought, if you always griped at your algebra teacher that you're never going to need y equals mx plus b, I'm here to tell you, you actually do. When the m is big, right? When the slope of the curve is big, it moves in to capture that slope. So in that point, it moves into what I would call a 2x position, which means you're getting twice of what the market's getting. Now, markets sometimes go up, sometimes they go sideways. Sometimes they move in channels where there's no trend. And remember, the computer, the algorithm doesn't get scared, it gets confused. And when it gets confused, when it sees no trend coming, it says, I'm not guessing, I'm just going to back out to cash and see what happens. Sometimes the market goes up, sometimes the market goes sideways, and there are other times, I don't know if you're aware of this, where the market goes down. The markets don't always go up. And in this position, what this trend following algorithm would do would go into an opposite direction, what I would call a negative 1x, which means you're getting opposite of what the market is getting. So market drops 10, you go up 10. And then to finish out the curves, right? Sometimes it backs out back out to cash. Slope of the curve starts going up. Slope of the curve gets bigger and it adjusts back and forth. So the cool thing here is every algorithm works right up into the point where it stops working. So where trend following algorithms really, really work is when there is a trend. Big up markets, we got it. Big down markets, we got you. The challenge with trend following algorithms is they tend to suffer a little bit. They tend to struggle a little bit in sideways markets. Sometimes it's looking for a trend that doesn't exist, and sometimes it guesses wrong. And that's why you would surround it with other algorithms that are doing different jobs at different times. And the idea is to be able to adjust to what's going on in the market automatically and to try to keep the elephant out of the way. So where does it fit? So the positive side of the tactical piece is it removes emotion from the market. Elephants are not present when there's a rule set. It has the ability to go defense, it has the ability to go offense, and it keeps both the rider and the elephant engaged. The rider's engaged because it's cool and it's math and it's algorithms and we feel like we're super smart. Elephant couldn't care less, right? The elephant is just trying to say, hey, look, does somebody watching the ship, somebody watching what's going on and adjusting what's happening? The elephant's more pleased with that part. The bad part about it, it's not magical. It's not trying to predict the market. Remember, it's just responding to what's going on. So it's if there's going to be short-term blips in the market, you're going to suffer through those. And it generally suffers in sideways market. When there's big trends up and down, we do well. And it's a little bit more expensive typically than pie chart investing because you're much more active in the movement of what's going on. So that's system one. System two is tactical. System three is what I would call contractual. So strategic, tactical, contractual. The contractual component of the system is sort of like special teams in football. It's there to help create specific solutions for very, very specific problems. So here's what that looks like. And here's some examples. So if you need the ability to create guardrails for risk and return, in other words, you need growth, but you need to manage some of your downside risk, it's a great solution for contractual. If you need the ability to create tax deferred growth, an account that's currently taxable, because maybe you're worried about tax rates over the next few years. I don't know who would be worried about that, but some people might be. Then a contractual piece could be a good solution for that. And if you need the ability to optimize income for retirement without giving up all the growth in the market, a contractual is a good piece for that as well. So some of these accounts can be created for very specific problems, and some of those problems can be short-term, like managing tax risk, managing interest rate risk, and some of them can be long-term solutions like managing income. So let's walk through an example of one kind of contractual solution. So again, if you remember back, way back, like an hour ago when we first started this, there was that slide that said all of these are hypothetical and just making up the numbers. Well, I want to give you one kind of contractual solution, and this is a concept more than a prescription. So in this solution, the goal in this particular solution is to find an alternative to bonds in a low interest rate environment. So in this strategic portfolio, in a normal strategic portfolio, the primary job of bonds is to help manage risk and to help look for returns in other places. The problem is that we've seen, and the predictions are for the next 5 to 7 years, we're going to be in this sort of muted interest rate environment, is that the bond half of the portfolio could be, if not adding value, basically just a placeholder. It's just there. So one solution to that is go all equity. Right? Forget bonds, we need return, let's go all equity. But not everyone is risk tolerant enough to handle that kind of volatility. The other option is to just suck it up, buttercup, just sort of deal with it for the next 5 to 7 years and know that 20 to 30 to 40% of your portfolio is not returning much, and that's fine. But the third option is to maybe do something a little bit different and add in that contractual piece. So in this solution, the company that we're working with will track typically an index, like an index might be the S&P 500. And what they're doing, and this is my sort of super complex, super detailed slope of the curve, right? And what the company is doing is On the downside, the company is going to take the first 10% of any loss in the market. They're going to buffer the loss. So if the market's down 5, you're down 0. The market's down 12, you're down 2. So they're taking the bottom end of it. And in return for that, they're muting a little bit of the upside. And what they're using in this is a strategy called a trigger strategy. And what happens in a trigger is if the market is 0.000% rate of return or higher, you get the trigger. And in this example, I'm going to use 10% as a trigger. So let's watch how this works. So year one, the market's sort of recovering. It's doing okay, but not quite done yet. It's down about 5%. Well, in this example, your account is 0. You didn't lose any money because the company you're working with took that first 10% buffer. The next year, the market's great. We love the market. Everything's going wonderful. The market is up 12%. We're very excited about that, but you get 10. You're going to get all the way up to the market up to 10. That third year, the market's up 2%. Not a great rate of return in the market. But remember, in this one on a trigger, any number higher than 0 and you get the 10%. So market's up 2, you get 10. Next year in the market, year 4, market's down 12. So remember, the company is going to take the first 10% of any loss, and that means you're down by 2. And in the final year in this sort of menagerie of dots and stars, the market is down by 4. And again, because the company's taking that buffer, you're down by 0, you're flat. So what this looks like and where this possible application for a contractual piece for a client's portfolio, I'm going to make up a client that's got $200,000 in assets. And it's a roughly 40-60 split, 40% bond, 60% equity. So in this example, we're going to take 80K or about 40% of their portfolio and move it into this contractual solution because we want what the bond piece can give us. We want some of the risk mitigation, but we want to shoot for a little bit higher rates of return than what we're seeing in the bond market right now. So we move that portion over there to the bond side. And then we're going to take that rest of that 60%, that 120K, and move it into an all equity, all stock position in a traditional strategic portfolio. So I have the same amount of money, I've just split it into 2 accounts, and each account is doing its own job. And the goal again is to have some downside protection, but with a little bit more rate of return opportunity than just having that money live in bonds. So contractual's place in the system, right? Fees can be very low in contractual solutions, sometimes even 0, which helps manage costs quite a bit in a portfolio. The other place it can be is a really kind of a cool Goldilocks solution to risk and return. If you've got a situation where you need to get some rate of return, but you're a little bit worried about the market, but don't want to get out, this would be a great solution. It gives you a permission slip to be more aggressive in other parts of your portfolio. Remember, it's thinking as a system, not as an account. And it can help you solve specific problems. The downside, because you're getting some protection on the downside, normally your upside potential is a little bit throttled, a little bit muted. The other part of that is if you're entering into contractual stuff where they're giving you protection and upside growth and the whole deal, usually you're going to give up a little bit of liquidity on that side of it. And the final piece is contractual. You typically wouldn't have this as a 100% solution for every dollar in your portfolio. It's usually meant for specific sleeves in that place. The last part of the system and the Ethereum, the Bitcoin, the GameStop, whatever you want to go do is if you have a strong elephant that needs to go gamble, we're going to bet on American Airlines. It's at 2 pennies. It's at 3 pennies. We're going to buy low and watch that baby go to the top. Then go build a side account and go to town. I sort of liken it to giving your kid a block to play with at church. Let them kind of do their own thing and go manage their own stuff without being destructive to the overall portfolio. And it helps, the key part of that is it helps them feel like they're engaged without the potential for, we bet everything we have on Bitcoin and it went the wrong way. Or we bet everything we had on GameStop, hoping that ride was going to keep going up and just waiting for the next drop to fall. So the last part of this is, what does the system actually get you? The key is trying to manage your risk and return, try to manage the elephant. And the key to managing that is to build a system. So there's an old saying, and I'm not gonna do the French version of this, but I think it's a French saying because I suck at speaking French. So the French saying is, the more things change, the more they stay the same. The challenge is I have no idea what tomorrow's going to bring. Are we going to have more taxes tomorrow? I don't know. What's inflation going to look like? Is there going to be a market crash? What are interest rates going to look like? None of these things I can control. And I hate to tell you this, none of these things you can control either. But the key is, in order to win in the market, you got to be in the market. But what the system gets you is a way to have smart adaptability to what's going on. Because just blindly staying in the market the whole time may not serve you as well as you think. Because you typically don't, the general populace, doesn't have the stomach to ride the waves, right? So having that system builds in smart adaptability, and it allows you to diversify not just your assets, but your approach, and to win in different accounts in different markets. The other thing, and the fun part for me, is it allows more fine tuning for what's going on. If all of my eggs are in one basket, it's either in or out, or messing with the mix of it. But if I've got multiple accounts doing multiple jobs, I can fine tune what's going on and adjust strategically to keep up with what's going on. And the final part about this is diversity helps with managing not just risk, but also cost. Strategic is cheaper than tactical. Sometimes contractual is cheaper than all of those. It's being able to place your bets and doing it in a much more cost-efficient way, but also managing your risk and the elephant at the same time. And so as the writer, because the elephant can't form words, so it's your job. What is the writer's job? Well, as Mary Lyons is fond of saying, 90% of success in life is tricking yourself into making good choices. It's setting up a system so that you can actually manage the system and not touch it. And the key is to think about the system as a system and not think about it as a specific account. When you start thinking about it as an account, you're in trouble. Because the writer's job at that point is to understand what's going on, but the key job of the writer is to understand the elephant. So when you start feeling those pangs, those sort of fears in your stomach, that twinge up the back of your neck that says, I'm worried, that's the elephant speaking. And if you can understand what's going on, then you've got a much better shot at it. So in closing, we'll let everybody get back to their day. There's really two questions that you should be asking yourself, but also asking your current advisor. And the first is, what's your philosophy? There's a little bit of what I would call a taste great, less filling, philosophical back and forth when it comes to advisors. Some advisors are very much about strategic. I don't know what your problem is, but we need pie charts to solve all your problems. Some advisors have a very tactical view of the world. I don't know what your problem is, but we need to be able to change every 5 minutes. And some advisors have I'm not sure what your problem is, but bumpers saves lives. We need all contractual all the time. And the key question is, where does your advisor come down? Is it all or nothing, or is it a blended approach? But the second part of this, and the part that I think is actually more critical, is who is actually managing your assets? And what I mean by that, I've been doing this about 12 years now. And when I first got into the business, I was drawn to the business because of the technical piece. I can do this thing, I can pull this lever, I can turn this knob, and my clients are better off for it. I can do all these cool things, right? I like the engineering part of it and building out systems. But what I found pretty quickly going into this is that the human side of the business is way cooler than the technical side. One of my favorite jokes is, if you can't be an athlete, at least be an athletic supporter. So one of the cool things about this job is getting to come alongside clients and to be part of their world and to be a part of their system and to help walk through life with them, and the highs and the lows and the plans and the dreams, and being a part of their world, right? And what I notice is the more and more of my day that got sucked up with client meetings and being there and answering questions, then less and less and less time I had left over for actually watching the market. And I started doing the math, and it was about an hour a day that I could actually devote to what's going on in the market, how's it going, doing some analysis, trading accounts. And I started to realize I'm not a professional anymore. I'm now a hobbyist, right? Because if I'm not watching the market all day long, I'm not really a professional in the room. And so it's about that time that we decided to move from being the guy, the girl, managing all the assets, doing all the client meetings, to bringing in third-party asset managers to help manage the client's accounts. And it got us a couple of cool things. One is the asset managers allowed us to access institutional level funds and accounts and choices without having to have institutional level dollars, which is really cool. It opened up to a much broader world for clients. The second thing is it gave us a whole second set of professionals whose whole job every single day, every hour of every day, they weren't in client meetings, they weren't doing compliance reviews. Their whole job every day was managing client accounts, buying and trading and moving and adjusting. And finally, and the part that I found the most sort of fascinating is it got our ego out of the equation with clients. So here's what that looks like. If I build a plan and I'm picking the stocks and I'm doing the trading and I'm managing all the stuff, and you come to me and say, hey, Eric, I'm really upset about the performance in this account. While I don't have a very big ego, I do have a tiny bit of an ego. And it's hard for my ego not to step in and go, what do you know? I'm the guy managing the deal. I've got all the degrees and all the whatever. You don't know anything. And I've all of a sudden got to justify my job and my worth to you as your advisor. But if I change the focus where I'm focused on you, what's going on with you emotionally, mentally, what's going on in your world, and you're upset about something, then it's a very different conversation. You and I are now on the same side of the table. Like, hey, Steve, I understand that you're not upset. I understand you're not happy. You're a little bit upset with this. So we have a couple options. We either tweak the account, change kind of how we're managing it, or let's fire the advisor. Let's fire the asset mark or the flexible plan or the Jackson or Lincoln, whoever's doing it. Let's fire the third-party manager and put another one in place, and let's get rocking and rolling with the new one. Allows us to be the quarterback of what's going on, and we're just picking the team. And what that allowed us to do is to refocus where we were and to stay focused on the client and not the specific day-to-day. And it also allowed us, when we did this, when we had that blended approach, what we also found is that it lowered our risk, because one manager, one third-party asset manager couldn't wreck the whole system, because we weren't just diversifying the assets, because we're diversifying approaches. We're also thinning out, we're sort of leveling out some of the risk on that side of it. My handy dandy spreadsheet watch here. We're right on time.
Yes. So if you have a question, feel free to unmute yourself and ask your question.